What is up, everyone? Welcome back. Really excited today because we're going to invest 500 real-life buckaroos using a very intuitive metric in mathematical finance called the Sharpe Ratio. Now, one thing I'll say off the bat, this is not the most complicated method, but I think that comes as both a con and a pro. The con, of course, is that you can use a more complex method that's taking into account more complicated interactions that we don't look at in this video. But the pro, of course, is that this method, as we'll see, is very intuitive, easy to understand, and has a pretty high ease of use. With that said, let's get into it. So this method starts by saying there's a list of tickers that I want to see if are good candidates for me to invest in. These tickers can be for anything from individual companies like Microsoft, Google, Tesla, to the entire market, the S&P 500 as a whole, to some things in between. You can invest in a ticker that is trying to capture the oil industry or the healthcare industry, for example. This method will work for all of those. For each of these ticker symbols, we look back over some period of historical data. So this is one of those things that you can play around with. That can be a month, can be up to a year. There's trade-offs here too. The more recent data you look at, the more recent trends you're capturing. But the farther back you look, that could be useful too if those farther back trends are actually going to influence prices in the future. So looking at just 3 tickers here for simplicity and color coding them, you see there's this red ticker symbol time series, this blue ticker symbol time series, and the green ticker symbol time series. What are each of these time series measuring? Each of these time series is measuring the percent change. So it could be week over week, day over day. It depends what time period you're looking at for each of these. It's the percentage change from one time period to the next. So this horizontal line here you see is 0. So you can see they dip below 0 if there's a negative return from one time period to the next, or they're above 0 if there's a positive return from one time period to the next. So one interesting artifact you see in this chart, looking at the red and blue time series, you see they're highly correlated with each other. They almost follow each other exactly. Now, this is not uncommon when you look at a very large set of ticker symbols, because some companies, even though they're separate companies, can be in the same industry, and if there's some industry-wide trends that are affecting stock prices, then it's very likely that those industry-wide trends are going to affect all of the companies that fall under that industry. For example, the tech industry could face some kind of layoffs, or you could have the oil industry, maybe there's some political crisis that causes prices to fluctuate. And so it's not unexpected to see these move together. But it's important for us to know this because the first step of this method actually involves constructing a graph, the very mathematical form of a graph where we're looking at nodes and edges connecting those. And those edges between these tickers are dependent on the correlation that we see in this chart here. So for example, here's the blue ticker 1, here's the red ticker 2, and we draw this edge because they're highly correlated. Their returns are highly correlated with each other. We don't draw an edge between T1 and T3 or T2 and T3 because those are not very highly correlated with each other. So these gray circles represent just some other tickers you would care about, and so you imagine there's many more links in this graph based on those correlations. For example, maybe T3 is highly correlated to this guy, and this guy, maybe these two are highly correlated to each other, maybe T2 is highly correlated to this one over here. And you see by doing this, we're creating a graph with a set of connected components. So if you haven't studied graph theory before, that's totally okay. All we mean when we talk about connected components in graphs are sets of nodes who are all connected to each other via some path. So if this was our final graph here, you would see that there's one connected component right here. There's another connected component right here, and there's another connected component right here. So there's 3 connected components in this graph here. Why are these connected components important in the context of this correlation graph between percent changes in the stock price? Well, if you think about it, if you look at this connected component up here, what it means to be a connected component is that this is really highly correlated, these two are really highly correlated. So in general, everything within this connected component are highly correlated stocks to each other in terms of percent change. And so you ask yourself, do I want to invest in all of these stocks? Well, not really, because they're so correlated with each other that investing in one of them is like investing in all of them because they share a very similar percent change return. And so that's why we say down here, the next step is from each connected component we identify, we are going to pick at most one stock to invest in. So unpacking that a little bit, we're either going to pick 0 or 1. That's what at most 1 means. And so both of those choices, whether we pick one at all, and if we are going to pick one, which one do we pick, is where the Sharpe ratio comes in. So now we get to the part of the video where we get to talk about the really cool metric in mathematical finance called the Sharpe Ratio. To talk about the Sharpe Ratio, our story actually starts with what's called a risk-free investment. So as you probably noticed, anytime you invest in a stock in the stock market, there's not a guarantee that you're going to make money on that. You could make money if you're picking your stocks wisely, or if you get lucky, you could totally lose money. And maybe that's a good place to mention in this video too, that I don't want to mislead the viewers in any way. We're going to buy some stocks at the end of this video, but please know that they're based on this method, but we could totally end up losing money on them. In fact, this is just the first video. In a follow-up video, which will be released about a week after this one, we will see how we actually did, and I will be very explicit with you. Maybe we will lose money. We will see. But that brings us back to risk-free investments. A risk-free investment, the most typical example of one in the United States, are called US Treasury notes or Treasury bills or Treasury bonds. The difference between those three, whether it's a bill or a note or a bond, is usually just the time frame over which you are buying that asset. So we'll just talk about notes today. So imagine you buy a 10-year Treasury note. What that means is that you're going to purchase this note right now from the US government, and you're going to give the US government some amount of money, maybe $100. Now, since it's called a 10-year note, every 6 months for the next 10 years, they are going to pay you a little bit of money risk-free. You never have to wonder how much that money is going to be or whether it's going to come to you at all. It's definitely going to come to you, and the percentage of your initial payment you gave the government in the first place, right now, as of filming that video, is annual 3.74%. So for example, if you give the US government $100 today, every year you're going to get back $3.74. And so we think of these as risk-free. People generally think there's zero risk attached to it. Of course, in the real world, lots of things can happen and nothing's ever risk-free, but this is about as risk-free as it's going to get. You consider, I have this $100. I could just give it to the US government and I could be collecting this 3.74% per year. Or I could buy a different asset. Maybe I spend that $100 and buy some shares of Microsoft stock or Tesla stock, or I invest in the S&P 500. How do you know which one's a better idea? And that's where the Sharpe ratio comes in. It helps us identify if one asset is quote unquote better than another. If that other asset follows two criteria. It has a higher return than the US Treasury note. So for example, it's giving you more than 3.74% per year. And it also has a generally low risk. Are we getting enough return relative to the additional risk we're taking on in order to justify buying this asset, spending our $100 on this other asset instead of the US Treasury note? And this very little formula here, very simple formula called the Sharpe ratio, captures this stat. So let's unpack this. The numerator of the Sharpe ratio is the expected difference between the return you would get from some asset A and the return you would get from the risk-free asset. So this R, subscript RF, is the return you would get from a risk-free asset, and we already know what that is on this page. As of now, it's 3.74%. So we know already based on the numerator alone that if this thing, the Sharpe ratio, is going to be positive, we need to have at least as much return with our other asset as we do with the risk-free investment. If this was less, then this numerator would be negative, and because the denominator is a standard deviation, which has to be positive, then the whole Sharpe ratio only works, is only worth it, positive, if we're getting at least as much return. Now talking about the denominator here, the denominator, sigma sub A, is the standard deviation of the additional return we would get from investing in this A versus this risk-free asset. Now, as we said before, we can think of this risk-free asset of basically having zero variance. It's risk-free. Therefore, we get away with writing just sigma sub A, which is just the volatility or standard deviation of the returns we're getting from this asset A. So basically what this formula is saying, what the Sharpe ratio is saying, is that a asset is better if it has high return, so if this R sub A is high, and if the sigma sub A is low. So if the numerator is high or the denominator is low of a fraction, in this case the Sharpe ratio, then the entire thing gets bigger. So things are better if they have very high return compared to the risk-free asset, and if they have very low volatility for that return. So here's a couple examples for you. Here is case one. Let's say that the expected return you would get from an asset is 5%. Let's say that the standard deviation of the return from that asset is 0.5%. So we would take 5% minus this 3.74% in the numerator, divide by 0.5% in the denominator, and we get a Sharpe ratio of 2.52. Notice here the Sharpe ratio has no units because the numerator is in percent, the denominator is percent, so it just cancels out. So generally speaking, Sharpe ratios between 1 and 2 are considered pretty good. Sharpe ratios between 2 and 3 are considered very good, and Sharpe ratios above 3 are generally considered amazing. So in this case, this is a very, very good Sharpe ratio. Let's look at case 2, a different asset who has a return of 10%. So if we were looking just at the expected return, we would say, whoa, the return of this asset is double this asset. We should totally invest in it. But the story is complete when you look at the standard deviation of the returns on this asset, which is a whole 8%. So that's so much higher than the standard deviation from this asset. And that reflects in the Sharpe ratio when we compute that. So that would be 10% minus 3.74%, all divided by 8%, and we get a Sharpe ratio of 0.78, which is not that great and definitely worse than 2.52. So if we were making this decision about whether to invest in 1 or 2 based on the Sharpe ratio alone, you could see here we would definitely want to pick 1. And that is the intuition behind the Sharpe ratio. I should, of course, take this moment to call out some drawbacks of the Sharpe ratio. And I'd say the two big family of drawbacks. One is the time period over which you're computing the Sharpe ratio. To be fair, that's a drawback of any metric you would compute around time series finance data. If you're looking at too short of a time period, then maybe the Sharpe ratio is excellent in that short time period, but if you were to go a year before that, you see that the overall Sharpe ratio is really bad. And that story can be flipped on its head. Maybe if you look too long of a time period, the Sharpe ratio is bad, but maybe that's not really reflective of where this company is going in the future. So maybe actually you want to look at a shorter time range when calculating Sharpe ratio. So that's something to be aware of. The other main drawback of the Sharpe ratio we can look at by just seeing its simplicity. Again, as I mentioned at the beginning of this video, this is a simple method, and that simplicity can be a con. If you look at this formula, all it's taking into account is the expected value of your stock's return and the standard deviation of your stock's return. We just had a whole video on why means and standard deviations are not enough in statistics. You definitely want to look at higher order summary statistics like skewness, like kurtosis, look at the full distribution of some kind of return. And we're definitely not looking at the full distribution with the Sharpe ratio. So there could be more complex dynamics in your stock return going on, and you would just fail to capture those by just looking at the expected return and the standard deviation of the return. So it's crucial to keep in mind that while the Sharpe ratio, and this kind of general rule of thumb of between 1 and 2, between 2 and 3, greater than 3 being good, very good, and very, very good, while that's generally a good rule of thumb, there are definitely corner cases out there, and you definitely want to take a critical look at what the Sharpe ratio is recommending to you in terms of stocks that you want to buy and see if those actually make sense by giving it a deeper look. And so just rounding out what the overall strategy is, sorry about the sun here, guys. I think I'm filming these at a time I don't usually, and so I'm trying to block the sun with my body. So the end of the story is that we've created all these connected components. Now, within each connected component, we said we're going to pick at most one stock, at most one ticker from here, because we don't want to invest in things that are just highly correlated with each other. And so what we're going to do is look within each connected component, and if all of their Sharpe ratios are negative, which means that they're actually giving us worse return than if I just bought a US Treasury note, then I'm not going to invest in any of those stocks. It just doesn't make sense. But if at least one of their Sharpe ratios is positive, then that will be the one that we select as a candidate from that connected component. So let's say that T1 has a positive Sharpe ratio, and therefore we're going to say, yep, you're going to be selected as a candidate. Let's say that T3 has a positive Sharpe ratio. We're going to say, yep, you're considered as a candidate. But let's say within this connected component, there are no stocks, no tickers with positive Sharpe ratios. So we just ignore that connected component altogether. So we grab kind of the winner in terms of Sharpe ratio from each connected component. And there could be tons of connected components. Let's say there's like 20 connected components. So that gives us a maximum of 20 winners. We're going to rank all of those descending by Sharpe ratio, kind of taking the winner of all the winners, and we're going to invest in, let's say, the top 4 or 5, again, ranking descending by Sharpe ratio. And the amount of money of the $500 we're going to invest that goes to each of these winners of winners is going to be proportional to their Sharpe ratio. So for example, let's just say we're looking at T1 and T3 and we've decided I'm going to invest in T1 and T3. Let's say the Sharpe ratio of T1 is equal to 2. Let's say the Sharpe ratio of T3 is equal to 1. Well, then I'm going to break up my $500 proportionally so that the amount I invest in T1 is twice as much as the amount I invest in T3. And so, enough talking about the method. Let's go ahead and look at the actual stocks that we're going to invest in based on running this method on every single stock in the S&P 500, so all 500 so stocks in the S&P 500, as well as some other ticker symbols as well. All right, so here we go, everyone. We're in the code where we're actually going to buy these stocks. So we're going to be looking at every stock in the S&P 500. This is generally a list of 500 companies in the American economy that are meant to be a diverse set. And so you can see all of them here. There's many, many of them. But we're not going to stop there. We're also going to look at some ticker symbols that represent things like sectors. So specifically, we'll be looking at these sector ETFs. You can see some of these sectors represent gold. You can see some represent the technology industry or the healthcare industry. We're also going to be looking at tickers that represent different countries besides the United States. For example, we'll be looking at tickers that represent the Japanese economy or the Brazilian economy or the Mexican economy. So looking at this very large set of ticker symbols, we see the first part of the process we were talking about is constructing these correlation graphs. And you can see here all these connected components that are getting suggested for us from this correlation graph. So we can do a quick exploration here. For example, here's one connected component consisting of 3 tickers that are all connected to each other, which means each one of them is highly correlated with the others. If we look into what these tickers actually mean, so the first one here is called Oxy, O-X-Y. This is a petroleum corporation, so oil, gas, energy, that whole sector. We see another one is called MRO. So if we look at MRO, that is also an oil corporation. So that totally lines up why they'd be correlated with each other. And the last one, EOG, is a energy company engaged in hydrocarbon exploration. So we see this totally makes sense where these 3 tickers are very correlated with each other and are in the same industry. And so all this kind of checks out. So you can see these connected components. Some are small, some are much larger. And again, we're only going to pick one, at most one, from each connected component. And that one, that's the candidate, is in blue. So this has the highest Sharpe ratio out of all the other ones in this connected component. So after we do that, and we look at the top 10 tickers who are not correlated to any of the other tickers in this top 10 list, and rank them descending by Sharpe ratio, these are the 10 that we get. Now, here's the part that comes in where we actually take a close look at each ticker's time series over the last week, because we're going to be using this strategy as a 1-week term investing strategy. That's what we're going for this time around. And so we'll take a close look now at what is the behavior of these tickers, these 10 tickers returned by our method, in the last 5 days. So there's 2 that we're going to rule out based on the fact that their time series look a little bit suspicious. And this is kind of not based on science anymore, but again, because the Sharpe ratio is only taking into account the expected value and the standard deviation, it does us some good to do a sanity check for these ticker symbols. So one of the ones that was suggested was Microsoft. And we look at Microsoft over the last 5 days, you know, it looks a little bit volatile. Maybe it is increasing generally, but I'm going to rule it out for this time around and not invest in it based on the time series looking a little bit more volatile than I would be comfortable with. The other one we're going to rule out is MPWR, which is Monolithic Power Systems Incorporated. You can see there definitely is a positive trend in the last 5 days, but it's mostly accounted for by this pretty monumental jump within just a couple hours. So the end of one day and the beginning of the next. There was likely some big news story or some big event or an earnings call or something that happened in this time period. And so I don't know if this trend will necessarily continue. In fact, you see it's been kind of negative to flat since then, and so we'll rule this out as well. So I want to be really, really clear that this is an important part of the process, where just because this method suggests some stuff to us doesn't mean we should just blindly invest in it. We should take a look and see what are the other dynamics going on that cannot be captured by just expected value and standard deviation by itself. The other 8 tickers that are suggested, though, are fair game, so there could totally be problems with them if I read into all the news and I did much deeper analysis, but I think this is a good middle ground for this video where we take a look at these other 8 ticker symbols over the last 5 days, and there's nothing that screams out to me that's crazy about these charts, that's really problematic, and so I feel comfortable for this experiment and seeing if this method is a good candidate for methods I'll try in the future to invest in these stocks. And so those 8 stocks are exactly these. And we say we want to invest $500. And this little table tells us exactly how much to invest, how many shares to buy of each of them right now, so that the total amount, so the last column, if you add up these investments amount in each of these 8 tickers, is going to be $500. And here's the number of shares we buy of each. So we go visit our stock trading platform and we do exactly what this table tells us to do, and now we are the proud owners of some shares of each of these 8 stocks. And that's the end of this video. Check in back for the video that happens a week from now to see if this went well or if it went poorly. Could really go either way. So thanks for watching until now. Leave any comments you want in the comments section below, like and subscribe for more videos just like this, and I'll see you next time.